what I want to do during the next 15, 20 minutes is just maybe give some broader perspectives, partly based on my own research and partly kind of forward-looking, also referring actually to some conversations that we are having, maybe you are having too, in the regulatory and supervisory community. So the first thing I want to mention, when we talk about digital finance, often the word financial innovation also comes into mind. And I think probably in the very first day you had this presentation probably by Lorenzo, Laura, maybe Nicolas, on kind of the broad introduction. And I think you've seen also some financial innovation already be mentioned there. I mean, you can go back actually to double book accounting, or how do you call it, double entry, book entry accounting that was actually here, so supposedly invented here in Florence. Of course, to all kind of other innovations that are either more technical, the telegraph, for example, or the introduction of certain new products, of certain new players, investment banks, money market funds, and so on. And actually, when I first thought about this topic, I actually realized that I actually, on a personal level, yeah, believe it or not, I was involved actually a little bit in financial innovation myself. So I've never had a kind of a permanent job in a bank, but I did a couple of internships, and I remember in the mid-90s actually, working at Deutsche Bank in Frankfurt on what was later, I guess, becoming a credit scoring model. Not in Excel, actually, that was not invented yet, I think it was the predecessor to Excel, and I forgot what exactly it was called. Yes, exactly, that one. Oh yeah, you're my age, yes, thank you. Right, so this was, I think, I mean, that's how I understood it. It was kind of a way to kind of, for a loan officer in the branches to kind of give a quantitative assessment of a borrower, and that we just worked on. And again, this, the computing power, of course, helped with that. The other experience I actually had with financial innovation, you could call it maybe a less good one, was when I worked in Costa Rica in a bank, in a private bank, during a time when only government-owned banks were allowed to offer checking accounts. So they wanted to kind of maintain the monopoly of government-owned banks. There were private banks that were allowed to offer time deposits, that were offered to do loans, and the rest of the financial services. Well, how many people would open an account just for savings and investment purposes? Well, there was a way around for this bank, basically going through a subsidiary somewhere in the Caribbean and offering indirectly checking accounts to their customers. So that's also financial innovation. I guess this is financial innovation kind of more, as we also like to call it, regulatory arbitrage. Which gets me to the more general point that financial innovation has these different sides, the good, the bad, the ugly. Right, so we think sometimes, so another innovation that I've always liked to quote, because of when I'm more in the developing part of the world, mobile money, M-Pesa in Kenya, now also in many other countries, that is definitely a financial innovation that has been incredibly positive. It has increased financial innovation, but then there are also other types of financial innovation where we think they're actually good, such as better ways of being able to manage risk, hedging risk, diversifying risk. But when you can better hedge and diversify, better manage risk, you might also have the incentive to take more risk, right? So kind of partly offsetting or even more than offsetting the effect of better risk management. So that's where then both sides of financial innovation comes in. And then, of course, financial innovation is often also associated with exuberance. Subprime credit boom and then bust in the US comes to mind. Similarly, in several European countries, when the euro was introduced, lower interest rates, and then suddenly there was a housing boom. Now that might not necessarily have to do with financial innovation, but it was an exogenous shock that on the first look was very positive because suddenly lots of people could get access to external funding for their mortgages, which before they couldn't. But then, of course, we know it didn't end up very well. So there's always this kind of, well, the economists like to call it on the one hand, on the other hand, or trade-off tensions between the good side and the bad side. And again, if you go back through history, there's always this question that comes up, which is also the title of a rather famous book, is this time different? And of course, I mean, is this time different also refers now to what you have been discussing about during the last 3 days or so. And I want to talk about two specific things. in this context, briefly. One is more the digital assets, currencies, crypto world, and then I want to very briefly talk about artificial intelligence. Now, on the crypto side, actually one of my colleagues at the ASC came out saying, let them burn. So he doesn't believe in any of this stuff, although he has moved a little bit away from it. He went public on record in the FT with that, so that's not, don't spill any beans here, any secrets. So you could argue on the one hand, yes, the technology, blockchain is groundbreaking. The question is, the products that come on top of it, such as crypto assets, cryptocurrencies, do they have any use, or is it purely speculative? And sometimes we also use the word decentralized finance, DeFi. Is it really decentralized? Or is there rather a small group of miners who kind of dominate the market, and then also now more and more of the market in DeFi or in crypto assets, so currencies actually moving to centralized exchanges, where you might even not invest directly anymore, but indirectly in crypto? Is that really the original idea of DeFi, of crypto? Has it become speculative? Purely speculative? Is it maybe the tulip mania of the 21st century? That's what I sometimes call it. Tulip mania, for those who don't remember, you're not old enough maybe. In the 16th or 17th century, there was this big boom and then bust in tulip bulbs in the Netherlands. Prices going through the roof and then suddenly coming down again and again. And if you think about it, a tulip bulb does, of course, have a real value underlying it, but definitely not, I don't know, 10 or 20,000 euros in today's money or so. Now, actually talking to people about this, is it the tulip mania of the 21st century? Someone recently told me, another academic, actually a legal scholar, well, he sees, yes, there are among all these now thousands, tens of thousands of crypto assets, currencies, there are some that are scams, there are some that are useless, but he thinks that if only 15% of all these crypto assets and currencies are somehow useful, that's a big success. Yes, that's a way to look at it. That's a bit like, you know, sometimes what venture capitalists do. The question, of course, for supervisors, regulators is, well, what about the other 85%? And what about the investors in the other 85%? Do they feel scammed afterwards? Do we have to think about consumer protection? How can we distinguish the good from the bad and from the ugly? So that's along this dimension. So again, I'm still very skeptical of crypto, but I'm always happy to learn further. Now then, a couple of years ago, there came the idea, well, how can we link the crypto world to the traditional world? And that's when the stablecoins came into making. Of course, the most famous one to be proposed, not to be implemented, was the DM Libra, which then in turn scared many central banks into the idea of central bank digital currencies, which I want to briefly talk about. Now, stable coins, how stable are they? I mean, if they're really stable, then their value should have a standard deviation or volatility of 0. Unfortunately, it doesn't. Even a volatility of 0.1% would be not stable anymore, and many of these stable coins don't seem as stable. Now, when we talk about central bank digital currencies, 2 quick remarks. One is to say, well, it's the new cash. And maybe it also helps, for example, in developing countries, increase financial inclusion, another kind of way into the financial system. The experience, as far as I have seen, so far is not very good, not very positive. There hasn't been really much take-up of central bank digital currencies where they are being offered in several countries now. In one country where it's still on the pilot phase, in some provinces in China, it's not really seen as necessary because you already have the payment system that the big techs, Alibaba and Tencent, have introduced. So the question is that really useful for that, for financial inclusion? So the jury is maybe out, but so far not really good. Now, if we talk about Europe, I mean, as I see it, the digital euro is not a CBDC. It's basically a payment system. And talking to people at the ECB, actually kind of all but confirmed this. Somebody called it the European PayPal, which is, of course, then the idea is then less kind of becoming more efficient or introducing a new kind of form of money, but more for strategic autonomy. So make ourselves a little bit independent of the US payment companies and payment system. Now, from this viewpoint, actually, this could, of course, be something very attractive. Ultimately, then also it is basically, I mean, the way it's supposed to work is like a payment system. And for those of us here in the room, including myself, who have accounts in several countries in Europe, maybe it is a good thing, because when I send money from my Italian to my Dutch bank account, it still takes a whole day, which is, I don't quite understand why. But today is maybe a case to be made. Of course, the question is, should it really be the central bank? Should it really be the government who does that, or could it have been also the private sector? But that question maybe might be a bit leading us too far away. Now, let me, a final point I want to briefly make, coming to AI. So one way to think about innovation is, especially about the current wave of financial innovation, is that it's technological innovation driving financial innovation. And one thing is, of course, the speed with which information can be collected, can be transmitted, can be processed, and then, of course, with this also the speed with which decisions can be taken based on the data. If you think again, 100, 200 years ago, telegraph, things became quicker. Then the internet came up. And now with the internet becoming quicker and quicker, and of course also not just information is being transmitted much faster, but a computer can also process information, data much more quickly, and ultimately become, and much more accurately, much more efficiently, much more information. And ultimately this the idea is to make the financial system, to make decision processes much more efficient, maybe have less of a human touch to it, which might be biased, but rely more on machines. And of course, part of that is artificial intelligence, which I see, I mean, there's a lot of, I'm not going to go into the definition of artificial intelligence, but for me, the one key function is the learning. The ability of the algorithm to actually learn, not just to apply something that has been designed by humans, but then also learn over time and become more efficient. How do you define that? It's another question. And you can see again, as before, looking at the good sides, at the bad sides. The good sides, yes, it might make financial institutions more efficient. Again, rely on more data, better processing, and so on. But by making more accurate decisions, it can also help exclude more and more parts of the population. Think about an insurance. If an insurance company, let's say a medical health insurance company, knows, based on information that I have to provide, knows with exactly 100% certainty that I will die in 5 years of cancer, well, they're not going to give me a policy, right? So there's definitely an issue there. Of course, we also have to take into account that an algorithm does not necessarily is completely independent, but the starting position might actually also determine what ultimately comes out. So there are lots of opportunities, but there are of course also lots of risks, including just in terms of how financial sector decisions are being taken. Now, maybe more important, and this note I want to almost close, there is of course also a way that artificial intelligence can create systemic risk. And for me, one big question is it just more of the same? Is it like digitalization? We know that digitalization can create new sources of risks. Can also AI create, is that AI just a continuation, just a higher level, or are there additional risks? And I haven't come to a complete conclusion yet, but if I think of some of them, some of the problems with AI is, of course, the complexity, the opacity, so hard to understand, especially for higher level decision makers. Think about boards, CEOs. There might be herding effects. If all the models go the same way, then all the financial institutions might go the same way. That, of course, can lead to higher volatility and to additional risks. There might be interconnectedness coming from the use of AI. There's a speed issue. Can we actually stop it in time, or will it get so out of hand that we can't really control it any longer? And of course, and that comes in also to geopolitics, can it be abused? Is there malicious use of such? I mean, we talk a lot about cyber risks, cyber attacks, which become more and more common. Could it also actually another entry channel or another kind of exacerbating factor? Could AI be one of these exacerbating factors? Of course, there's then also the, I mean, it's not just creating risk, it's also then amplifying risks. So I think that is, in general, an area that at least I think in the regulatory supervisory community is a big topic, and that is still being studied. The big question is, of course, how should regulator supervisors react? Well, number one, we have to understand it better. Number two, how do we deal with the fact that financial institutions use AI? How do we regulate, supervise it? Do we need specific stress tests? That's a legal question. I mean, if the AI takes a decision, who is liable for this decision? AI is not a legal person, right? So there's a lot to be said in terms of, a lot to be thought about in terms of both the opportunities again, but then again the risks, and especially then also the challenges in terms of how to deal with and how to regulate, supervise AI within the bank in terms of governance structure, but also for us regulators and supervisors, how do we think about the use? How do we make sure it's being used the right way, so to say, and it doesn't create additional risks that might not be even known by today?